Welcome back to the Deep Dive. This is the show where we take a massive stack of research articles, expert notes, historical findings, and we try to distill it all down to the essential, fascinating, and sometimes, frankly, alarming truths you need to know.
That's right.
Today, we are diving deep into a fundamental instrument of home ownership and finance. We're talking about the adjustable rate mortgage, or ARM.
And if you live outside the United States, you probably know this as something else, maybe a variable rate mortgage or a tracker mortgage. But the core idea is exactly the same everywhere.
And what is that core idea?
It's a mortgage loan where the interest rate and, because of that, the monthly payment you have to make is periodically adjusted. It changes throughout the life of the loan.
Okay, let's unpack that right away because the language around mortgages can be so confusing. We're talking about the rate itself changing, not just, say, the payment schedule.
Precisely. The whole engine here is that dynamic interest rate. It's tied to some external verifiable financial indicator. An index.
An index.
Yeah, an index that reflects what it costs to borrow money on the big credit markets. This is completely different from something like a graduated payment mortgage, where the rate is fixed for 30 years, but your payment just starts low and goes up on a set schedule.
So in an ARM, the payment is changing because the underlying cost of money is actually moving.
That's it.
So if the rate itself is dynamic, we're really talking about an instrument that's designed to do one main thing for the lender.
Oh, absolutely. It's about risk.
It's about transferring risk.
100%. ARMs are built, first and foremost, to shift that big piece of interest rate risk, the chance that market rates will just shoot up from the lender's books directly onto you, the borrower.
But there has to be a trade-off, right? You don't just take on all that risk for nothing.
That's the hook. That's the key benefit. Because the lender is now shielded from that future volatility, they can afford to offer you a lower initial interest rate.
And that's the part that gets everyone's attention. That low starting number. It's seductive.
It is the primary incentive. You see that low starting rate, you compare it to the fixed rate loan, and it just lowers that initial hurdle to buying a home. A lot of finance experts have even suggested that unless interest rates are already at rock bottom, you, the borrower, should probably prefer an ARM.
That sounds completely backwards. You're saying prefer the riskier product.
Well, even with the risk, that lower initial cost lets you save more or invest more in those first few years of the loan. It's a fascinating piece of counterintuitive advice.
Okay, so our mission today is to go way beyond that low teaser rate. We need to dissect the nine core components of an ARM.
That's right.
We have to understand the global variance that, let's be honest, led to financial crises. And then we have to confront this really surprising history of systematic calculation errors and financial scandals that are tied to these contracts. This whole thing is like a math puzzle, and you, the borrower, are the one holding the bill. Okay, let's start with the basic anatomy of an ARM. We often just think of it as a rate that moves, but the source material says there are 9 core features that come together to make this thing work. Let's start with the essential 3: the index, the margin, and the initial rate.
These 3 are absolutely foundational. So number 1 is the initial interest rate. That's just the rate you pay when you first sign the papers and close the loan. Simple enough.
Right, the starting line. But that rate gets replaced pretty quickly by the real engine of this whole thing, which is feature number 3, the index rate.
The index is the fundamental driver of your cost. It's that external rate the ARM tracks. It reflects the cost of borrowing money for the banks themselves, and it's moving all the time. Your rate is literally tethered to it.
Which brings us to number 4, the margin. Now, this sounds like the lender's profit.
It's their profit and their insurance, exactly. The margin is a fixed number of percentage points, let's say 2%, that the lender adds on top of the index rate.
So index rate plus the margin equals the actual rate I pay.
That's your fully indexed rate. And what's crucial here is that the margin, that 2%, is written into your loan contract, and it is fixed for the entire 30-year life of the loan. It never changes.
So the bank is guaranteed their cut no matter what.
It guarantees them a consistent profit spread, whether the market index is high or low.
So if the index is, say, 4% and the margin is 2%, my current rate is 6%. If that index shoots up to 6%, my new rate is 8%. But that 2% for the lender, That's always there.
It's the bedrock of the contract. That stability for the lender is the entire reason the ARM exists.
Okay. Now let's look at the other features, the ones that are less about the math and more about, I guess, controlling the risk and the flow of payments.
Mm.
You mentioned feature number 2, the adjustment period.
Right, and this really sets the rhythm for your risk exposure as a borrower.
How so?
It's the set amount of time that the interest rate stays completely frozen before the lender is allowed to reset it. Based on the new index value. It might be every 6 months, it might be once a year, or for some products, only every 5 years. But that date on the calendar, that's when your risk becomes real.
Then there's feature number 5, and I think you could argue this is the most important one for protecting the borrower. Interest rate caps.
These are the guardrails. They are limitations on how much your rate or your payment can change. They're designed to prevent the rate from rising too much in one go or too high over the whole life of the loan. We're going to have to spend a lot of time on caps because they're really the only defense a borrower has.
Okay, then we have the features that, let's be honest, can be used to hide the true cost of the loan. Number 6, initial discounts.
The famous teaser rates. This is when the lender offers a promotional starting rate that's actually below the real fully indexed rate, below the index plus the margin.
Like a sale price.
Exactly. They might offer you a 3% starting rate when the actual calculated rate is 5.5%. It's a really powerful incentive. It makes your first payment super low, but it guarantees you're going to get a sharp jump at that very first adjustment.
Which leads us straight to number 7, the most terrifying feature for most people. Negative amortization. Neg-am.
This is a really high-risk feature. It happens when the monthly payment you choose to make is actually less than the interest that's due for that month.
So where does the unpaid interest go?
It gets added right back onto your principal loan balance. You are literally borrowing more money to pay the interest you already owe.
So your debt is growing every month, even though you're making payments. You're losing equity.
That's exactly what's happening. We absolutely have to dig into this when we talk about the more wild types of ARMs later on.
For sure. So the last 2 features seem more procedural. Number 8 is conversion.
Yeah, this is like a potential escape hatch. It's a clause that might let you convert your ARM into a fixed-rate mortgage at certain points during the loan, usually for a small fee.
And finally, number 9, prepayment terms.
Everyone needs to be really careful here. Some ARMs, especially the ones with those deep teaser rates, have penalties if you pay the loan off early.
Like if you refinance.
Exactly. If you refinance within the first few years. You have to check your contract to see if there's a prepayment penalty and, how long it lasts. Our sources say these are sometimes negotiable, but you have to check before you sign.
That breakdown really clarifies just how many moving parts there are. Okay, let's drill down into the index rates themselves. You said these external numbers are the engine that drives the whole thing. The number of different indices used just seems dizzying.
Well, they do fall into a few distinct categories. In the U.S., for instance, you'll see indices that are tied to government debt.
Like what?
Things like the constant maturity Treasury or CMT index, or the 12-month Treasury average index, the MTA. These are pretty transparent because they're based on the government's own cost of borrowing.
Okay, and then you have indices that reflect what it costs banks to get money.
Right. The really famous one was the London Interbank Offered Rate, LIBOR. For decades, it was the dominant global index, but it's being phased out now after all those manipulation scandals.
Right.
You'll also see things like the 11th District Cost of Funds Index or COFFI, which is based on the average cost of funds for a group of savings and loans out on the West Coast.
And what about internationally?
Oh, you see all sorts. There's the Australian Bank Bill Swap Rate, the BBSW. In some cases, believe it or not, they even use the General Consumer Price Index, the CPI, which links your mortgage rate directly to inflation.
That variety stands out. I mean, why would a lender pick one index over another? Is it just random?
No, it's very strategic. A lender that picks an index that closely tracks their own internal cost of funds, like the COFFI index, is making sure there's a really tight match between their expenses and their income.
So if their funding costs go up,
their mortgage income goes up almost at the same time. On the other hand, if you, the borrower, pick an ARM that's tied to a less volatile index, like that 12-month Treasury average, you might get smoother adjustments. But the lender is taking on a little more risk that the index won't perfectly match what they're paying for their money.
So if a lender uses its own cost of funds as the index, that's the ultimate risk avoidance play for them. They're making absolutely sure their margin is safe no matter what happens.
Okay, so if we connect this all back to the complexity of the ARM, what's really fascinating is that the index isn't always applied in that simple way we just described.
Right.
There are actually 3 different adjustment mechanisms that you'll find in loan contracts, and understanding which one governs your loan is absolutely critical if you want to predict your future payments.
I think most people, myself included, always assumed it was just index plus margin. But you're saying that's just one way of doing it.
That's only one of the mechanisms. Let's start with the simplest one. Mechanism 1, the directly applied index.
How does that one work?
In this structure, which is pretty rare, the interest rate on your loan is exactly equal to whatever the current value of the index is. If the index is 5%, your rate is 5%. It mirrors the index perfectly.
So there's no margin.
Essentially, no. The source material says you really only see this when the index itself is a contract rate index, one that's meant to reflect an average lending rate. It's super transparent, but, very few lenders will do it because they could lose money if their own cost of funds goes higher than the index.
Okay, that makes sense.
Hmm.
Which brings us to mechanism 2, which you said is the most common one, the rate plus margin basis.
This is the one we've been talking about. The interest rate is the current value of the index, plus that fixed margin you agreed on when you signed the loan.
Let's use an example.
Okay, let's say the index is the CMT, and it's at 4%. Your agreed-upon margin is 2%. For this period, your interest rate is 6%. Simple.
And if the CMT goes up to 5% at the next adjustment?
Your rate becomes 7%. The calculation is direct, it's clear, it's predictable. You, the borrower, know exactly what your cost will be just by looking at the index.
Okay, now for the tricky one. Mechanism 3, the movement basis. This one sounds like it introduces a lot of opacity.
It really does. In this structure, your mortgage starts at some agreed-upon initial rate, which may or may not be the true, fully indexed rate. But here's the key. The adjustments that follow are tied only to the movement of the index.
Not by adding the margin to the current index.
Exactly. It's not based on the current value of the index plus the margin.
Can you give us an illustration of that? Use the same numbers?
Sure. So index is 4%, margin is 2%. With the standard rate plus margin model, your start rate is the fully indexed rate, 6%.
Right.
Now, with the movement basis, the lender might offer you a slightly different starting rate, maybe 5.5%. Then, at the first adjustment, the index has gone up from 4% to 5%. That's a 1% upward movement.
So how do they calculate the new rate?
The new interest rate will be your initial rate, the 5.5%, plus the movement of the index, that 1%. So your new rate is 6.5%.
Ah, okay, I see the difference. It's subtle, but it's huge. In the first method, the new rate would be the current index, 5%, plus the margin 2%, which is 7%.
Right.
But in this method, it's the starting rate, 5.5%, plus a change in the index, 1%, which is only 6.5%.
Exactly. The final rate under the movement basis is way less predictable because it's anchored to that initial starting rate, which could have been set arbitrarily. You, the borrower, have to track not just the current index value, but what the index was at the last adjustment too.
And that complexity, I can see how that's where the errors start to creep in.
This is where operational errors thrive.
That right there proves why these are so much more complex than a fixed-rate loan. When the basic math has 3 different versions, the chances for a simple human mistake or a computer glitch just multiply. And with that kind of complexity, you absolutely need some serious protection against the rate hikes. This is where it gets really interesting for me, because the central fear for any ARM borrower is payment shock. That sudden, huge jump in your monthly payment when the rate resets. If the index is the engine of risk, then the caps have to be the brakes. How are those brakes actually designed?
The caps are absolutely the critical structural limits on how much things can change. Without them, the financial risk would be, well, astronomical. They usually work across 3 different categories, creating a kind of layered defense for you.
Okay. What are those 3 layers of protection?
So first, there's the frequency cap. This just limits how often the rate can change. If your loan adjusts annually, the frequency cap means they can't suddenly start changing it every 6 months.
Yeah. And second?
The periodic change cap. This one sets the maximum amount the rate is allowed to go up or down in any single adjustment period. A very common one is a 1% or maybe a 2% periodic cap.
And third, the ultimate ceiling, the life cap.
This is the lifetime cap, and it sets the absolute highest your rate can ever go. For most primary mortgages, this cap is set at maybe 5% or 6% above your original starting rate. So if you start at 4% and you have a 6% life cap, your rate can never, ever go above 10%.
Let's dig into how those caps are structured, because it seems like they're not always the same. It sounds like the lender gets a bigger bite at the apple early on.
That is the key insight. The initial adjustment rate cap is often treated differently from all the ones that follow. This first cap only applies the very first time your rate resets, right after that introductory fixed period ends.
And the sources say this initial cap is usually more aggressive. Why would that be?
Well, the lender needs to get your loan from that artificially low teaser rate up to the real, fully indexed rate as quickly as possible. So if you have a short introductory term, maybe 1 to 3 years fixed, the initial cap might be 2% or 3%.
But if you have a longer fixed term, like a 5 or 7 year ARM,
Then the lender might set a much larger initial cap, maybe 5% or even 6% on that first adjustment. They have to play catch up for all the years they've been charging you less than the market rate.
so the longer you're safe in that fixed period, the harder that first adjustment is going to hit you, even with a cap.
Precisely. After that first big jump, all the later rate changes are limited by the much tighter rate adjustment cap. That's usually the 1% or 2% maximum increase per period. The idea is to smooth out the rest of the volatility for you.
This structure is why the industry came up with that number shorthand. Let's break down the 225 structure.
Right. That shorthand is essential for a quick risk check. A 225 structure means, first, a 2% cap on the maximum increase for your initial adjustment. Second, another 2% cap on the maximum increase for all subsequent adjustments. And finally, a 5% cap on the maximum increase over the entire life of the loan, measured from your initial start rate.
Let's walk through an example of how those caps work together. Let's say you start with a 3% rate, but the market has moved so much that your real fully indexed rate should now be 8%. That's a 5% jump.
Right. At that initial investment, that 2% periodic cap kicks in. So you're protected from the full 5% market increase. Your rate only goes up from 3% to 5%.
A 2% increase. But what happens to the other 3% the bank wants to charge me?
That extra 3% is basically banked or carried over to future adjustment periods.
So at the second adjustment, if the market rate is still at 8%, the lender can use that banked increase, but they're still limited by that subsequent 2% cap.
Exactly. Even though the market still justifies an 8% rate, they can only raise your rate by another 2%, taking you from 5% up to 7%. They're still not at the fully indexed rate, but they're following the rules of the cap.
And that just repeats until my rate eventually hits that 8% market rate, or until I hit my ultimate ceiling, the life cap.
Right. In our example, the life cap was 5%, so your rate could never go above 8% anyway. That's the 3% start rate plus the 5% life cap. That interaction between the caps is what's supposed to protect you from that massive one-time payment shock. It spreads the pain out.
Now, we have to contrast this whole controlled system with the big exception from the source material. Home equity lines of credit, or ELOXs. This really shows how much protection those standard ARM caps actually provide.
Oh, ELOCs are a completely different animal. They're usually used for second mortgages or for revolving credit. A standard ARM has those rigid 1-2% periodic caps and the tight 5-6% life caps. An ELOC, though,
What do they have?
they often have no periodic caps at all. Their only limit is usually whatever the maximum interest rate is allowed by state law, and that could be as high as 18% in a state like Florida.
18%. That is a completely different universe of risk.
And their index is different too. ELOCs are usually tied to the Wall Street Journal prime rate, which is what's called a spot index. A spot index can change immediately based on what the Federal Reserve does. So if the Fed raises rates, your ELOC rate can, in theory, jump straight up that day all the way to that 18% state ceiling.
Wow.
There's no gentle periodic cap to protect you.
That makes the distinction crystal clear. A standard ARM is designed to shield you from immediate catastrophic change, even if it eventually pushes your rate higher. A ELOC, on the other hand, offers almost no protection from that period-to-period volatility.
As the ARM evolved, lenders were always trying to find that sweet spot, that balance between giving the borrower some stability and making sure the lender's risk was covered. And this led to some really powerful new versions, starting with the hybrid ARM.
The hybrid ARM.
Yes.
This sounds like an attempt to get the best of both worlds, the security of a fixed rate and the low cost of an adjustable one.
It's the great compromise. A hybrid ARM has a rate that's fixed for an initial period. It could be 3, 5, 7, even 10 years. And then after that period is over, it automatically converts into a regular ARM that adjusts annually for the rest of the loan.
And we use that XY terminology to describe them.
Right, X over Y, where X is the number of years in that initial fixed period and Y is the adjustment interval after that. The classic example is the 51 ARM.
A 51 ARM. So fixed for the first 5 years, and then it adjusts once a year for the remaining 25 years.
Exactly. It gives you a 5-year window of total stability. That's enough time to plan, maybe refinance, or hopefully earn more money before that inevitable adjustment finally
The
hits.
hybrid ARM became incredibly popular in the early 2000s.
It was an absolute explosion. In 1998, hybrid ARMs were, less than 2% of new 30-year mortgages? Just 6 years later, that number had soared to 27.5% of the market. Lenders loved them, borrowers loved them for the lower initial payments. It just seemed like a win-win.
But the hybrid, as you said, is relatively safe compared to its wild cousin, the auction ARM, also known as the pick-a-payment ARM. This is where the danger just skyrockets.
The option ARM is unique because it starts by offering you 4 different monthly payment options. It gives you this incredible cash flow flexibility, which sounds great, but it introduced a level of risk we'd never seen before.
So what were those 4 payment options?
You could choose from 1, the standard 30-year fully amortizing payment. That's the safest option.
Okay.
2, a 15-year fully amortizing payment if you wanted to pay it down faster. 3, an interest-only payment where your loan balance never goes down. And 4, the minimum payment.
The minimum payment. And that was often based on a ridiculously low teaser rate, like 1%.
Correct. And that 4th option, the minimum payment, is the gateway to that toxic feature we mentioned earlier, negative amortization.
So when you choose a payment that's less than the interest you actually owe,
The math of your debt completely reverses. Let's use simple numbers. Say the interest due this month on your loan is $1,500, but you choose the minimum payment option, which might only be $1,000. You have a shortfall of $500.
and that $500, it doesn't just vanish.
No, it is immediately added right back onto your outstanding principal balance. So if your principal was $250,000, now it's $250,500. And next month, you're paying interest on that higher balance. You are actively digging yourself deeper into debt with every single minimum payment.
This was marketed so heavily during the housing boom. It let people qualify for much bigger houses because they were being approved based on that tiny minimum payment, not on their ability to actually pay the full interest.
That's exactly right. The problem is that negative amortization can't go on forever. This whole mechanism leads directly to the payment shock trigger, which happens when the loan is forced to recast.
And there are 2 ways that can happen. The first is by reaching the neg am cap.
Right. Every option ARM had a contractual limit on how high your principal balance could grow, usually between 110% and 125% of what you originally borrowed. So you took out a $200,000 loan with a 110% cap the moment your balance hit $220,000 because of all that unpaid interest.
The loan recasts.
Immediately. And when it recasts, the payment doesn't just gently adjust. The minimum payment option is gone forever, and your new payment is instantly reset to a fully amortizing level over the remaining term at the current fully indexed rate. The payment jump could be 50%, 75%, even double what you were paying overnight.
And the second trigger is just a deadline.
The automatic recast date. This was usually mandated every 5 years. It didn't matter what your neg am balance was. On the 5th anniversary, the loan automatically adjusted to fully pay off over the remaining term at the current rate. Even if you were super careful, that 5th year still hit you with that massive payment recalculation.
So the ideal borrower for this kind of product has to be an absolute financial whiz.
They really do. Option ARMs are only suited for very sophisticated borrowers. People with growing or fluctuating high incomes, someone who expects a huge bonus and can manage short-term cash flow, but is fully prepared to pay down all that accrued negative amortization before the recast date hits. For the average homeowner, this product was just a financial time bomb.
Okay, let's pivot and talk about the big picture here. The why. Why did banks invent and then push these incredibly complex, high-risk products? And the answer, as you touched on, goes back to a core vulnerability in banking itself, the asset-liability mismatch.
This is the heart of the whole matter. A bank's business model is to take in short-term liabilities, that's basically your deposits, which you might have to pay you back tomorrow, and they use that money to issue long-term assets, which are mortgages fixed for 25 or 30 years.
So if the bank is paying depositors 1%, but they have a mortgage locked in at 5%, everything's great. But what happens if the Federal Reserve jacks up interest rates and suddenly the bank has to pay 8% just to keep those deposits?
That is the nightmare scenario for a bank. Their cost of funding, their liability, is now higher than the income they're getting from their asset. That mismatch puts the entire bank's survival at risk, and the source material is very clear that this was the flaw that made the U.S. savings and loan crisis in the early 1980s so much worse.
Explain that connection, because that's a huge moment in financial history.
The S&L crisis was fundamentally driven by this mismatch. The S&Ls were sitting on huge portfolios of old, low-interest, fixed-rate mortgages. When Paul Volcker, who was the Fed chairman, aggressively raised interest rates to fight inflation, the S&Ls had to start paying, say, 15% or more to their depositors just to stop them from pulling their money out.
But their income from those old mortgages was locked in at 6 or 7%.
They were losing a massive amount of money on every single loan they held. It drove widespread insolvencies and was a huge contributor to the crisis.
And the ARM was the direct structural solution to make sure that never happened again.
Exactly. By offering ARMs, the bank transfers that interest rate risk to you, the borrower. They guarantee that their income from the mortgage, which is index plus margin, moves in lockstep with their own cost of funds, which is the index. They hedge their risk perfectly.
And it's important to realize that outside the U.S., the variable rate loan isn't the specialty product. It's often the default.
It is the standard structure. Variable rate or tracker mortgages are the most common way people buy homes in the UK, Ireland, Canada, Australia, and New Zealand. In Canada, for example, your mortgage might be for 25 years, but the longest you can typically fix the rate for is 10 years, often much shorter.
Why is the UK in particular so reliant on variable rates?
It's tied to the history of their building societies, which have always dominated the mortgage market there. By law, these societies have to raise at least half of their funding from customer deposits.
So they're heavily reliant on those short-term liabilities.
Exactly, and because of that, they overwhelmingly prefer to issue variable rate mortgages. It's a structural preference that ensures they aren't exposed to that interest rate risk between their funding costs and their lending income.
Now let's look at the contrast. Fixed-rate systems like in Germany and Austria, how do they offer long-term fixed rates without facing that same asset liability threat?
They do it through a very unique and restrictive model. It's centered on these institutions called Bausparkassen, which are mutual building societies. They do offer long-term fixed loans, but the system forces you into mandatory savings for years upfront.
A forced savings plan.
It's a prerequisite, essentially. You, the borrower, have to save up a significant fixed percentage of the loan amount in regular monthly installments before you're even allowed to get the mortgage. And you can't just show it with a lump sum. You have to save over time.
That structure guarantees stability for sure. The payment is fixed years in advance, but it requires a level of long-term planning that might not work in a more mobile economy.
It's really aimed at once-in-a-lifetime buyers who can plan their finances a decade ahead. The source material suggests that even in those countries, if you expect to move or refinance within, say, 3 to 7 years, the lower rate you'd get from an ARM's introductory period can still be the better financial option.
Let's close this part with a history of how the ARM actually came to be in the U.S.
So the very first variable rate product was authorized in 1980. It was called the renegotiable rate mortgage, or RRM. It was a very cautious first step. The rate could only change every 3 years, and the life cap was only 5 percentage points.
And then in 1982, the floodgates opened.
The Garn-St. Germain Depository Institutions Act of 1982. That's the law that fully authorized the creation and widespread use of adjustable rate mortgages as we know them today. It gave lenders the tool they felt they needed to stabilize their balance sheets.
That tool was later massively misused. In 2006, right before the financial crisis, over 90% of all subprime mortgages were ARMs.
90%. And subprime loans were 20% of the entire market. That concentration meant that this instrument of risk transfer was placed overwhelmingly in the hands of the most financially vulnerable borrowers, which, set the stage for the wave of foreclosures that came next. So if we connect that history to the actual mechanics of the ARM, the really profound risk isn't just that rates might go up. It's the operational complexity of the loan itself and its just overwhelming potential for systematic error and, in some cases, for deliberate predatory practices.
Let's start with that intent. When does a financial product that's meant for risk management cross the line and become a predatory loan?
Well, according to consumer advocates, an ARM becomes predatory when it's sold to someone who is clearly not going to be able to handle the rising payments if and when rates go up.
So if you're approved based only on that 1% teaser rate,
and you have absolutely no ability to pay the real fully indexed rate of 5% or 6%, that's considered predatory. Because the lender knows that payment shock is not just possible, it's inevitable, and for that borrower, it will be unaffordable.
the caps and the rules are supposed to protect people. But what happens if the banks and the servicers managing these incredibly complex loans can't even do the math right themselves?
This is where the source material gets truly shocking. We're talking about the interest rate error epidemic of the 1990s. The complexity of the 9 features, the different indices, the 3 adjustment mechanisms, it just completely overwhelmed the companies servicing the loans.
So tell us about the findings of that 1991 Government Accountability Office study, the GAO study.
The GAO looked at about 12 million ARM loans in the U.S. They concluded that a staggering 20% to 25% of them had interest rate errors.
1 in every 4 or 5 loans was wrong.
That's what they found. One former federal banking auditor estimated that these mistakes led to at least $10 billion in net overcharges to American homeowners. This wasn't just a few mistakes, it was systemic.
$10 billion. What were the actual mistakes they were making? How does that happen?
It was very technical, administrative stuff. The servicer would use the wrong bait for the index value, so they'd use last month's number instead of this month's, or they'd use the wrong margin, or they would just completely ignore the periodic or lifetime caps and overcharge the borrower anyway. The computer systems they had just weren't adequate to track all the moving parts.
And the problem actually got worse, not better.
It did. By December of 1995, another government study came out. It concluded that the error rate had actually gone up. They found that 50% to 60% of all adjustable rate mortgages in the United States contained a calculation error.
Half of them. An absolute majority of the loans were being serviced incorrectly.
And the estimated interest overcharges in that study alone exceeded $8 billion.
50 to 60%. Yeah. That's not a margin of error. That is a complete operational failure of the system that was supposed to administer these loans. The complexity was literally self-defeating.
The study blamed inadequate computer programs, clerical errors when filling out the documents, and just basic calculation mistakes. It shows this deep paradox. The very instrument designed to protect these sophisticated financial institutions was too mathematically complex for those same institutions to manage correctly.
What's really unsettling to me is the timeline. The government finds that half or more of these loans are wrong in 1995. So what did they do to check on it after that?
This is maybe the most shocking detail from the source material. No other comprehensive government studies have been conducted into ARM interest overcharges since that 1995 report.
That silence is deafening. I mean, if the system was fundamentally broken in the mid-90s, the fact that no one followed up suggests one of two things. Either the industry fixed itself perfectly, which seems unlikely, or the political will to expose that level of operational failure just vanished.
The complexity itself becomes a shield against accountability. And this problem isn't just a U.S. thing. We saw a huge international scandal in Ireland that showed it wasn't just errors, but calculated adverse actions against customers.
You're talking about the tracker mortgage scandal.
Right. In 2015, the Irish Central Bank started a massive investigation. These tracker mortgages in Ireland were very transparent, ARMs. They were linked directly to a European benchmark rate.
Oh.
Well, after the 2008 crisis, those European rates plummeted. And these tracker mortgages became extremely low interest, which meant they were unprofitable for the banks. So the banks, realizing they were stuck in these bad contracts, systematically and deliberately started moving thousands of their customers off the cheap tracker mortgages and onto more expensive variable rate products.
So this wasn't a mistake. This was a deliberate strategy to get out of a contract that had become too good for the borrower.
It confirms that when the ARM, this instrument of risk transfer, actually works too well in the borrower's favor, sometimes the lender will take deliberate action to claw that advantage back. So you, the borrower, have to be vigilant, not just against market changes or honest mistakes, but against the calculated self-interest of your loan servicer.
So after all of this, what does it all mean? We've taken a really deep dive into the adjustable rate mortgage, and what we've found is a powerful but mathematically intricate tool. It's incredibly effective for lenders. It lets them dramatically reduce their risk, protecting their business model from the whims of the market.
And for the borrower, it's a way to get a lower initial payment, to get into a home sooner. But those benefits, they demand an exceptionally high degree of sophistication from you, the borrower.
Right.
You have to be able to track the index, understand the difference between a hybrid and an option ARM, calculate what negative amortization is doing to your balance, and know the precise limits of your risk because of the cap structure.
The stability and the certainty of the 30-year fixed rate, that's really the premium you pay to offload all of that complexity. You're paying more to transfer that rate risk entirely back to the lender. The core choice really hinges on whether you are willing and able to bear that interest rate risk in exchange for a lower initial cost. It's a transaction that trades today's affordability for tomorrow's uncertainty.
And that raises an important final question for you to think about. Considering those historical findings that 50 to 60% of ARMs in the US had calculation errors, and the fact that the government hasn't followed up on that for nearly 3 decades, if this instrument is so complex that the lenders and servicers themselves routinely make multi-billion-dollar mistakes, how confident can the average borrower really be in their own ability to monitor and verify the true cost of their loan over 30 years? What is the real hidden cost of all that complexity when the very systems designed to track your payments routinely fail? The ultimate step you have to take if you enter an agreement like this is to demand radical transparency and maybe even secure an independent third-party audit to make sure the burden of being vigilant doesn't just result in you becoming the next overcharged statistic.